Here is the number that frames everything else in this video. Silver is changing hands near $58.40 an ounce this morning, Friday the 31st of July 2026, and that is being reported as a decline. Think about what that means. The previous all-time highs for silver were set at roughly $50 twice in modern history, once during the Hunt Brothers squeeze in January 1980, and again in April 2011. Silver failed at that ceiling for more than 4 decades. Today it is trading comfortably above it, and the story of the session is weakness. That is the paradox worth understanding. A pullback towards $58.40 is not the same event as a pullback at $25, because the entire price structure underneath it has been rebuilt. In March 2020, at the depths of the pandemic panic, silver traded below $12 an ounce. The move since then has completely repriced this metal. So why is silver softer today? The immediate answer is the US dollar. Silver, like gold and like crude oil, is quoted in dollars on the global market. When the dollar strengthens against the euro, the pound, the yen, and other major currencies, every ounce of silver becomes more expensive for buyers holding those currencies. Demand cools at the margin and the dollar price adjusts downwards. That inverse relationship is one of the most reliable in commodity trading. It is not a perfect correlation, and there are stretches where both rise together during genuine crisis buying, but on quiet sessions the dollar tends to set the tone. What is driving dollar strength is the interest rate story. When traders expect the Federal Reserve to keep policy tighter for longer, or when U.S. economic data comes in firmer than forecast, Treasury yields rise and capital flows towards the dollar. Non-yielding assets like silver, which pay you nothing to hold them, look relatively less attractive in that environment. The reason silver is defending such elevated ground has less to do with speculation and more to do with a genuine supply problem. According to Silver Institute data, the global silver market has run in structural deficit since 2021, meaning total demand has consistently exceeded total supply, with the shortfall covered by drawing down above-ground stockpiles. Those stockpiles are finite. Industrial demand has been the engine. In recent years it has run above 600 million ounces annually, a record for the metal. Solar photovoltaics alone account for close to 200 million ounces, because silver paste is used in the conductive layers of solar cells and no cheap substitute performs as well. Add electronics, electric vehicle wiring, brazing alloys, and medical applications, and roughly half of all silver consumed each year is burned through industrially rather than stored. Gold, by contrast, is almost entirely recycled and hoarded. That distinction is why silver behaves like a hybrid, part monetary metal, part industrial commodity. Professional traders rarely look at silver in isolation. They watch the gold-to-silver ratio, which simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Over the past 2 decades that ratio has broadly oscillated in the 60 to 70 region, spiking violently higher during crises. It reached an extraordinary reading above 120 in March 2020, when silver collapsed and gold held firm. That spike marked one of the great buying opportunities in commodity history. The ratio matters because it is a sentiment gauge. A falling ratio means silver is outperforming gold, which typically signals risk appetite, industrial optimism, and speculative enthusiasm. A rising ratio means investors are retreating to the safer, more liquid metal. If you want a single indicator to judge whether today's dip near $58.40 is a genuine trend change or ordinary profit-taking, watch whether the ratio widens materially over the coming sessions. This is not an abstract chart movement. At $58 an ounce, silver is a serious cost line for real businesses. Solar manufacturers have been engineering thrifting programs for years, redesigning cells to use progressively less silver per panel, and elevated prices accelerate that work. Jewelers and silversmiths face higher input costs that eventually reach retail price tags. Electronics manufacturers absorb it quietly into component pricing. On the investment side, holders of silver exchange-traded products and physical bullion have seen extraordinary gains from the 2020 lows, and a session like today is where profit-taking naturally appears. Mining companies are the other side of the coin. At these prices, primary silver miners are generating margins that were unthinkable a few years ago, though it is worth remembering that around 70% of global silver supply arrives as a byproduct of copper, lead, and zinc mining. That means supply cannot simply ramp up in response to price. If you are watching from Britain, there are two layers between the headline price and what you actually pay. The first is currency. Silver is quoted in dollars, so your real return depends on the pound-to-dollar rate as much as on the metal itself. A stronger dollar, which is precisely what is happening today, means a weaker pound, and that partially cushions the fall for sterling-based holders. The second layer is tax, and it is significant. In the United Kingdom, investment-grade gold bullion is exempt from VAT, but silver is not. Silver bullion attracts VAT at 20%. That single rule means a UK buyer needs a substantial price rise simply to break even on physical purchases, which is why many British investors prefer exchange-traded products, or storage in offshore vaults. London remains central to this market regardless, as the London Bullion Market Association sets the global benchmark price used in contracts worldwide. Technically, the picture is straightforward. The $58 handle is the psychological line in the sand for this session, and it sits just below where the market is trading now. Round numbers matter more in precious metals than in almost any other asset class, because they anchor both retail orders and automated stop placement. Below that, the 60-day and 100-day moving averages become the reference points that momentum traders defend. On the upside, the recent highs are the obvious resistance, and a decisive close above them would suggest the dollar rally is being ignored. One important caution for anyone trading this metal. Silver's daily trading ranges are historically far wider than gold's, often roughly double in percentage terms, because the market is smaller and less liquid. Position sizing that feels sensible in gold can be reckless in silver. Respect that volatility, especially into a Friday close when liquidity thins out in the late London and New York sessions. Looking to the near term, the dominant variable stays the dollar, and the dollar takes its orders from US data. The monthly American Employment Report, released in the first week of August, is the next major scheduled catalyst. A strong reading supports the dollar and pressures silver further. A soft reading does the opposite. Beyond that, watch inflation prints and any shift in Federal Reserve rhetoric on the timing of rate cuts, because falling real interest rates historically favor precious metals. The structural argument, however, runs on a longer clock. Deficits that have persisted since 2021, industrial consumption that is largely price insensitive in the short run, and mine supply that is mostly a byproduct of base metals do not resolve in a single quarter. The reasonable expectation, therefore, is continued high volatility around a firm floor rather than a return to the pricing regime that existed before 2020. So here is the summary for Friday, the 31st of July 2026. Silver near $58.40 is lower on the day, and the proximate cause is dollar strength rather than anything wrong with silver itself. The metal is still trading above every record it set in 1980 and 2011. The demand story from solar, electronics, and electric vehicles is real and measurable, not promotional. The supply side cannot respond quickly. If you are trading, respect the volatility and watch the $58 level and the gold to silver ratio. If you are investing from the UK, factor in 20% VAT on physical silver before you calculate anything. A dip driven by currency movement is a different animal from a dip driven by collapsing demand, and knowing which one you are looking at is the whole game. Thanks for watching, and we will update this analysis in the next session.